Hello, welcome back. Hope you had a nice Thanksgiving and an even better Black Friday and you bought some stuff there. Now, in this video, we're going to be taking a look at a not so known company, not a well known company. That is, it's called Elf Beauty. This was a request by one of our esteemed subscribers of the channel and visitors of our Discord channel as well. And so I thought it's an interesting one because if you take a look at this chart, you'll see that the company stock price has been moving sort of like upwards for a while, then went down and then boomed and boomed quite significantly. It's actually sitting at its pretty much all-time high, as you'll see here in the chart. Now, if you take a look at the 3 months, you can kind of see it even more clearly. It was sort of like basing here and then started climbing and climbing and climbing. Now, we will examine the financials here. But I wanted to talk about a couple of things when you see these kinds of companies that are climbing upwards. And you may be inclined to short, like the subscriber actually told me that they are more than likely inclined to short, which makes sense because this has been going up a lot. But when we're talking about a stock that is climbing and has been climbing for a while, it's sitting on an uptrend over here, it may be a bit dangerous to short. When you are shorting, when you are trading or even buying, depending on which kind of thing you want to be doing, you have to remember that the trend is your friend. This is a very, very well-known saying when we're talking about trading, because you don't really want to go, to go separate ways from what is happening with the current trend, because you can really, really get hurt. This happens all the time. You think that a company stock price has been climbing a lot and then keeps on climbing. So it's very, very easy to get distracted and be like, okay, how much further can it go? The same thing applies when we're having a stock that is actually going downwards. You may be thinking, how low can it go, and then goes lower and lower and lower, because that's the trend, and it's all about the sentiment and the buyers or the sellers, the people who are actually coming in. Now, we're going to be examining this one as a normal company, as a company which has, its usual financials aspect, and we want to be examining that. But I wanted to talk a little bit about this, the fact that you have to be careful about sorting into strength, as we are saying, because you can get burned. This can easily continue upwards unless the trend reverses. What you do want to do, if you are willing to short, you probably want to wait for some lower lows, like the company's stock price goes a little bit lower, then goes up a little bit, then even more lower, and then goes up a little bit, then even lower, and then goes up a little bit. This probably indicates a reversal in terms of the pattern of the trend. So this is where you probably would have a much better luck if you wanted to short. Now, if we take a look at the P ratio of the company and the price to free cash flow, they are super elevated. 107, 200. This is already a company that is looking very, very expensive, with outstanding shares actually also getting issued over here. So this is another X. The company has been issuing shares more and more. And also, it has quite some debt. So things are not looking great over here in terms of the financials. Now, if we're talking about the price maybe over here, then this may be much, much better. But right now it looks like it's getting more and more expensive. And you can kind of see it in our chart here. Like in 2018, this was much, much lower in terms of the price to free cash flow. Same thing with the 2021 over here, which was still elevated, but not to the level where it is right now, which is sort of like Tesla-like looking. Okay, so in terms of the margins of the company, 7.5%, slightly upwards, so at least that's a good thing. But remember, they have quite some liabilities compared to the free cash flow, yet their debt to equity ratio is going down, so they don't have a lot of debt. It looks like they mostly have a lot of total liabilities compared to the cash flow that they generate. That's the thing over here, which needs to be examined. We need to be taking a little bit of a closer look. This is exactly what we're going to be doing. Let's take a look. So, in terms of the income statement, a revenue of 200 million over here to 400 million, growing nicely, very nicely for the company. And in terms of the net income, 33 million to 21 million over here. So this is stalling growth over here. This is not going as well as you would expect. And the company is making $21 million. And remember, it's like a $3 billion company, right? If we go back to our metrics page, it's a $3 billion company making 20 million a year. That's not a lot. And that's net income. We will examine the cash flow a little bit later. But first, let's take a quick look at the balance sheet as well. You will see that the total assets of the company over here are sitting at 500 million and the total liabilities are 182 million, bringing it down to a total of 300 million in terms of total equity, which is fair. And the company, remember, has been issuing shares, like quite a lot of shares over here, additional paid-in capital. So this is not looking great, and also the return earnings are in the negative still. Now, what about the cash flow? What's going on, which is the very important thing over here? It's about the same as the net income pretty much, so it's almost a one-on-one over here, as you all see. Some stock-based compensation, depreciation, amortization, the usual stuff. And you will see that we are looking at 4 million back 5 years ago. We had 46, 34, 23, and 14, so this is a downward slope. Even though the stock is actually going upwards, this actually seems to be going downwards. So this is a negative sign, and I'm not really sure why people keep buying this. Again, it may be because of the trend. The trend is a very important thing. Don't forget that, and it can be heading the opposite way of what the company is actually doing in terms of its financials. Very usually you see that. Now, if we take a look at our stock evaluation tool over here, you will see that our revenue growth average has been at about, as you will see here, at about 11%, yet we obviously will go down more for 6 and 8 is what we're going to try, be a little bit more conservative. Net income margins of, let's just say, now it is getting a little bit better lately. Actually, it has been getting better last year, but lately not so much. It's sitting at about 5 to 6%. So I'm going to go in between 4, 5, and 6, and 6. And you will see that the free cash flow margin over here is all over the place. Once the company is actually starting to get less of a net income, pretty much over here, it's sloping downwards, I should say. So yeah, these numbers over here are really all over the place. You cannot really predict what kind of free cash flow the company will be generating, as you'll see over here. This probably has a lot to do with the inventory, I'm assuming, and obviously stock-based compensation and everything. But these things tend to be pretty much cyclical and sort of like you can predict them. But this one seems to be all over the place. We're going to go something that is somewhere in between the usual stuff, 80, 90, and 100. And an annual return of 13%. So let's see what we get out of this one. Now 3, 5, and 8 is what we're getting over here, which makes a much more sense based on what the company's financials have been. So as you can understand, this is a very expensive company, very expensive stock, I should say, based on what it is doing financially and based on the current price. It would be easy to guess. I mean, looking at the the price to earnings ratio here and the price to free cash flow, it already tells you that this is a company that is looking expensive, and the growth is not there. Like, there is some growth, but 45% in 5 years won't cut it for such an insane amount of growth here in terms of the company's company stock price. So this is expensive, and I definitely agree with our viewer that this is mostly a short, not really a buy. Yet again, because it's trending, I would be a little bit reluctant to short. What I would probably do here is wait and maybe not even touch this one, because it can continue going upwards, regardless of what the financials of the company are for a while. Now, everything corrects, everything goes back to normal eventually, but sometimes it can take a while. It really depends on market forces, how much people are willing to buy a company and how much they are willing to sell a company for. And so you have to be super careful shorting over here. I would be a little bit hesitant to short, to tell you the truth, but I would also not buy, definitely not be buying this one over here. So probably I would stand a neutral stance over here and just wait it out, see what's going to be happening. Now again, you kind of want to wait for potential lower lows, which we don't really see here. It's always like higher highs. You see, this was a high, this went lower, this was another high, and now it's going a little bit, it didn't even go lower. There's strength over here. So I would be careful. I would be careful because the market price action seems to be indicating that this could potentially go even higher, maybe for no real reason, but that's exactly what the stock market does sometimes. It's a lot about the sentiment in the short term, so be careful about these things. And I hope you enjoyed. I hope this helped a little bit. Do leave a comment below. Tell me what you think about this company, and I'll see you in the next video. Bye bye for now.